Keillen Ndlovu, Head of Property Funds at Stanlib, joins us for more on Investment 360. Keillen, thank you very much for your time. Looking at the companies that have reported in the property space, it's all been going very well to this point. However, Emira spoiled the party last night, didn't they?
Yeah, they reported the numbers last night, delivered negative 2.5% income growth compared to the other counters. You saw Resilient do 9%, Fortress did 10%, Capital 10%. And then we've got NEPI, which is a Romanian stock, about 15%.
15.6% on NEPI.
Yes. So NEPI is actually they own shopping centers and office buildings in Romania. If you look at NEPI, it's what South Africa was 10 years ago. So there's so much growth in Romania, so much shopping centers coming up there as well. So it's under-shopped area, so they're actually rolling out shopping centers in the smaller towns.
So that's just for the viewers out there, New Europe Property Investments,
yes.
NEPI, and that, as Keillen says, Romania.
But Keillen, these are great results. I mean,
amazing. Yeah.
You know, you would think that in an environment where the economy is only growing at 2 or 3%, for these companies to produce those kind of increase in earnings, I mean,
sure.
it really underpins. Should underpin buying in that sector.
Oh, definitely. Yeah, that's what I always say, that how defensive property sector is. If you just break them down, Resilient is dominant shopping centers in the smaller towns or non-metropolitan areas, so they dominate that space.
Do they get a percentage of turnover? I mean, is it based on turnover?
Yes, they do, but most of that is actually base rental growth. Okay. Turnover is probably 2-3% of rental earnings, which is quite nice because it brings less volatility in the portfolio.
Well, Resilient is still to report, though.
No, they have reported.
They've reported.
Yeah, they did 9% income growth.
Oh, of course, yes,
yeah.
I've got it here. Oh, and absolutely, 9%.
Yes. And the exciting thing about them going forward, they're looking for 10%. So they're actually building more shopping centers in Secunda, in Begersfort as well. So we like it. It's our best retail stock.
Well, that's a safe bet, don't you think?
Yeah.
If
look,
it's a safe
you know
bet.
what? It's a wonderful strategy, and I think that you know, hats off to the management of Resilient, who also gave us Fortress and Fortress B.
Definitely, yes, definitely.
And I was told, did I buy Fortress B by Mr. Zeidel? And I said, what does Fortress B do? So I'm hoping Keillen's going to tell me.
Fortress is an interesting one, actually. They own smaller shopping centers. So the retail is about over 60% in the portfolio. But those shopping centers you find in smaller towns, like in Toyando, in Standerton. So they're anchored by ShopRite, like a 10,000 square meter shopping centers. But they're in the townships or rural areas. That's where the population is. That's where the growth is. Get benefit from social grants as well. So they're doing very well.
David takes you very seriously. We've spoken about this before.
You make a lot of money on Capital.
You did. You bought Capital Property Fund. Should he still be holding Capital Property Fund?
Capital actually remains our biggest overweight position. It has done the job, but going forward as well, we've got 7% income growth in the next 12 months, which is still decent, above inflation, and it's trading at a yield of about 7.9. So it's in line with the sector, offers above average growth, and they're looking to expand. Those guys are amazing, very proactive in the industrial space.
Well, that takes me up to 8.5 yield next year. You know, that's great.
Yes.
Exactly, you can't be greedy here.
Yeah.
I was interrupting, you were asking a question, and I interrupted you.
What I wanted to ask about this, and it might be an unfair question, but if we start to see that kind of growth in the outline, a Resilient Fortress B type growth, can we translate it, you know, into retail demand? In other words, that we're seeing in ShopRite, in the people there. And also the one that I want to ask you is like some of the Builders Warehouse, Cashbuild, Italtile, you know, those companies that are selling there, you know, is it that strong to justify that we actually remain in retail stocks?
It depends on the market that you're targeting. So you want to be more in the lower income market. You go to the shopping centers. I was doing site visits over the last 2 days. Township is amazing. Even during the day it's busy. Go there on a weekend. It's volume driven. Spend per head is low, but huge spend there. I gave an example.
So which companies are there that we know?
So Fortress is a good example.
No, I'm talking the retailers.
Oh, the retailers. Oh, ShopRite. ShopRite is quite big as well, definitely. ShopRite, then you could take your Builders Warehouse as well. People still building. Go to the townships. Everyone wants to extend their house, look good, paint it as well. So probably, ShopRite is probably the one, and the fashion retailers as well, like a Jet as well. Edgar's does well, Mr. Price, definitely. So all the retailers in the lower income
There's an
market.
Interesting feeder story to what you were saying in terms of the building, is Italtile and also Cashbuild. They have done incredibly well.
Yes.
And that's exactly what you're saying. People are building their, renovating their houses
definitely,
as a way perhaps to cope with tougher times.
We saw even the one that disappointed was Dawn came out. But what they did say was that, you know, on their mining side, on the engineering side, they were doing very well. So we're still waiting for signs in some of those retailers, but I think underneath it, I'd probably go for a Mr. Price, ShopRite, you know, stay with him.
Definitely. Vacancy trends, those that have reported, what have been the trends there?
It's been great, actually, as well. Fortress probably increased from 5.6 to 5.7, so we call it an increase in our space. But Resilient decreased to less than 2%. Even Emira as well decreased, and Capital also a decrease in vacancies.
Did it surprise you that you're seeing a better position on the vacancy front?
So it's more in line with what we expected, but the office market continues to go up. So most of the decrease has been because of the industrial market. Industrial market has been good. Look at KZN, about 1% vacant. Average national vacancy about 4%. So you're seeing the decline in vacancies across the industrial space.
Is there still this big disparity between your A grade and your B grade office space?
Sure.
A grade is where to be, B grade is battling.
Definitely. Emira is a good example. Their office portfolio is about 50% of the total portfolio, and they're the only ones who have got vacancies of close to 20%, 19.8% to be exact, because they've got huge exposure to B grade office market. And if you look at the average vacancy, about 12.5 in the B grade space, whereas A grade is about...
Can you give us a little bit more clarity on A grade versus B grade? What are you getting? Why is B grade so... People don't like it at all. I mean, as you say, look at Emira. Yeah, 20% vacancy in that space.
Yes, it's actually competition between A and B grade. So what happened is we saw so much development happen in 2006, 7 and 8. So it's so many office developments coming through. So if you can't let that space, what do? You reduce the rents. And those rents become closer to the B grade space. And I'd rather pay 5–10% more and get a nicer new building, better parking, nicer aircon, better lighting, better space as well. So that's what is happening. So B grade can't compete with A grade at this stage. So we might see A grade filling up first.
Then the prices will push up. There will be a big enough discrepancy in price for people to say, I'm going to opt for B grade.
That's right.
We've got very little time left, but still to report Growth Point, Hospitality Property Fund, High Prop Investments and SA Corporate Real Estate Fund. Yes. Anybody you expecting to shoot the lights out on that front?
I would probably say between High Prop and Growth Point, but not as good as the companies that have reported now. So you're looking at about 5–6% growth from those counters, which is still decent. SA Corporate run about 2% because they've got smaller shopping centers as well, which don't really do well in this market. And Hospitality, we're expecting a negative 28%, 30% decline in income, because we know how the hotel sector has been doing. But B's even worse, probably about 50%. Yeah. You know,
that's bad.
The share price has fallen.
I know it has suffered a lot.
And some people say I'm probably looking cheap at these levels. We're doing more work around that. Because so City Lodge numbers looking better, but City Lodge is better positioned because they're in the 3-star space.
City Lodge?
No, I'm just giving examples in the hotel space. Hospitality has got 4 5-star hotels, and people prefer, with everyone cost cutting, you're going 3-star. We don't go to 5-star hotels at this stage. We're going to 3- and 4-star hotels. That means hospitality suffers in that process.
You've got time for one more very short question. Do you want to find out what you should be buying? Are you staying with Capital Property Fund? Are you going to buy into Resilient?
You said Vunani,
yeah. Vunani is still looking cheap, over 10% yield compared to the sector at 8%. So sometimes just buy and keep and wait for the rating to come.